Good afternoon. Happy Friday, February 21st. Mark Milam here, your mortgage professional. Let's get right to it. A pretty good week for mortgage interest rates. We're seeing the rates finish out this week at levels that are pretty impressive. We'll take it as we close out. These green days are good days, which means Friday, Thursday, Wednesday, and Monday all moving in the right direction. Tuesday, the only outlier. What was the cause of this? Well, we don't really see a lot in the economic data that would tell us, hey, this should have been a really good week for mortgage rates. Housing starts came in a little under expectations, but permits came in over. Initial jobless claims pretty much within striking distance of the consensus estimate. So what happened here? Well, it's a little bit up for debate, but one thing that got reported this week that's catching some people's attention is that the minutes from the January Fed meeting have been released, and we're realizing that the Fed board members discussed a potential end to quantitative tightening. What's quantitative tightening and why is it good for mortgage rates? I'll get to that in a minute, but here are the headlines. This one's from Reuters from February the 19th saying Fed officials weighed slowing or pausing bond drawdown last month. Here's one from Bitcoin. Bitcoin bulls rejoice. The Fed minutes confirm QT is ending. That's a little overstated. They did not say QT is ending, but they certainly did discuss ending QT at some point in the future. Why would that be good for mortgage interest rates? Well, to understand QT or quantitative tightening, you've got to understand QE, which is quantitative easing. And quantitative easing began in very late 2008. It really began in practice in early 2009 as a function of the Great Recession, too big to fail, the mortgage meltdown, whatever it is you want to call it. The Federal Reserve made a decision in late 2008 and began practice in 2009 of entering into the Treasury and mortgage-backed securities market as a participant, not just a regulator, not just an overseer, but as a market participant along with all the other private market participants out there. They introduced new demand, a new stable buyer, a big buyer of mortgage-backed securities, which helped suppress mortgage interest rates and drive up the value of those securities. As the value goes up, the interest rate comes down. And for a period of 13 or 14 years, the Fed did this. This is why we had the historically low interest rates of the decade of the 2010s and even moving into the pandemic. When you talk about what the Fed was doing, buying mortgage-backed securities throughout the decade of the 2010, boy, they took it to another level during the pandemic, and that's what drove interest rates to all-time lows in the United States during the pandemic. Then came 2022, and in 2022, the Fed not only ended QE, or quantitative easing, they began something called QT, quantitative tightening. And all of that demand that the Fed had put into the market had now been taken away. And this huge balance sheet that the Federal Reserve has of treasuries and mortgage-backed securities, well, as they reach maturity, the Fed was simply allowing them to roll off, and they weren't investing their dollars back into the market. So the Fed now effectively is completely out of the market as a buyer, and we're totally reliant upon the private network, whether that's banks or whomever, that's largely banks, buying up mortgage-backed securities specifically. So what does that mean? That means there's upward pressure on interest rates as the value of the securities come down. They have fewer buyers who want to buy mortgage-backed securities. That means interest rates go up. So now quantitative tightening has been an upward pressure on mortgage interest rates along with inflation and the Federal Reserve Fed fund rate hikes. Quantitative tightening has been an upward pressure on interest rates over the past couple of years. So the Fed talking about ending quantitative tightening, where they would no longer allow these securities to roll off and then not reinvest those proceeds, well, that's good news. How much rolls off in a given month? This is an important question. So when you talk about mortgage-backed securities specifically, the Fed is rolling off or allowing to reach maturity about $35 billion per month. So in effect here, what the Fed will begin doing is taking those proceeds from the maturing of these bonds, and they'll be reinvesting them back into the mortgage-backed securities market. Now, this doesn't mean they're going to be growing their balance sheet anymore, but they're not going to be shrinking it either. They will eventually just be holding steady and introducing a little bit of demand. Now, $35 billion in this market sounds like a lot, but it's not a tremendous amount. They'll be introducing some demand for mortgage-backed securities. What will that do? Well, that should put upward pressure on the value of those securities and downward pressure on the associated interest rates. That would be very, very welcome. It's going to be interesting to see how this plays out. I'll show you one other picture here. So These are the Fed holdings here in blue. This is the Fed holdings of treasuries and mortgage-backed securities. And you can see they've been rolling these off since 2022, getting their balance sheet down. This orange or yellow line are bank reserves in terms of liquidity. And you can see that as the Fed began allowing these to roll off, bank reserves fell. That makes sense that the banks would be now having to step in and buy up more and more of these mortgage-backed securities. But here of late, in 2023 and moving forward, bank reserves have been growing. Bank reserves have been coming up, and we're seeing that the balance sheet of the Fed holdings and bank reserves are starting to mirror one another, and it's going to be really interesting to see how this plays out. This isn't necessarily what the Federal Reserve expected, but it does show that the market now has some liquidity in it, and if the Fed now introduces a little bit more liquidity, boy, we could see some improvement on mortgage interest rates. When it comes to housing affordability, we don't have a lot of levers to pull, guys. We can't make housing prices go back down 25 or 50%. We can't make mortgage interest rates go down as a function of the Federal Reserve. These are market-driven rates. But the Federal Reserve ending quantitative tightening is a lever we can pull, and it sounds like a lever that's going to get pulled at some point this year. When? Well, that's anybody's guess, but my hunch is it will be sometime maybe end of Q2, beginning of Q3, that the Fed will end quantitative tightening. That could be an improvement for mortgage interest rates, and boy, would that sure be welcome. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com.